In 2018, one company stood at the very top of European finance. Wirecard AG, a German payment processor, was valued at 24 billion euros. It had soared past banks that had stood for over a century, institutions like Deutsche Bank and Commerzbank, once seen as unshakable pillars of European stability. Wirecard wasn't just another company. It was a symbol of modern finance, a digital titan promising to power the global flow of money in our increasingly online world. Then, in June 2020, the illusion shattered. 1.9 billion euros money that auditors believed was safely stored in Asian bank accounts had simply vanished. It wasn't stolen. It wasn't transferred. It had never existed in the first place. What followed was one of the most extraordinary corporate collapses in modern history, a scandal built on forged documents, international espionage, regulatory failure, and one of the most elaborate financial deceptions ever constructed. This is the story of how billions of euros became ghosts. Wirecard was born in 1999, right in the middle of the early internet's wild expansion. Online commerce was exploding, but traditional banks refused to touch many of the new online businesses. Industries like internet gambling and adult entertainment were considered too risky, too volatile, and too dangerous for their reputations. Where banks saw danger, Wirecard saw opportunity. The company positioned itself as a payment intermediary, quietly moving money between customers and these high-risk online merchants. These businesses generated huge transaction volumes and high fees, but they also required secrecy and flexible compliance. From its very beginning, opacity was Wirecard's natural environment. In 2002, disaster nearly struck. The dot-com bubble burst, pushing the company towards bankruptcy. Then, a suspicious burglary occurred at its headquarters. Computers and financial records disappeared. But instead of dying, Wirecard transformed. A new CEO arrived. Markus Braun, an Austrian consultant with academic credentials and grand technological ambitions. Braun envisioned Wirecard as the backbone of global digital payments, a company that would control every single step of a financial transaction. Under his leadership, Wirecard shifted from mere survival to aggressive, relentless expansion. In 2005, Wirecard made a bold and highly unusual move. Instead of a traditional public offering, the company merged with a failing call center firm already listed on the Frankfurt Stock Exchange. This maneuver, known as a reverse merger, allowed Wirecard to become publicly traded without undergoing the intense scrutiny of a conventional IPO. It was a legal shortcut, but it also meant fewer questions were asked about its complicated financial structure. Just 1 year later, Wirecard acquired a bank and obtained a full German banking license, which gave the company enormous credibility. It was now both a technology company and a regulated bank. This hybrid identity created a screen. Investors struggled to understand where its revenue came from, and analysts found it nearly impossible to separate banking profits from payment processing income. Wirecard used this complexity to its advantage. The company's growth depended heavily on a network of third-party partners, known as TPA. These partners supposedly processed payments in regions where Wirecard lacked licenses, especially in Asia and the Middle East. 3 firms became central to this network: Al Alam Solutions in Dubai, Senjo Group in Singapore, and Payzy in the Philippines. Wirecard claimed these partners handled massive transaction volumes, generating huge profits. Yet later investigations revealed they operated from tiny offices with minimal staff. Despite this, Wirecard reported enormous, ever-increasing revenue. The company used accounting methods that recorded the entire value of transactions as its own revenue, instead of just its commission. This inflated their financial results dramatically. To justify the imaginary profits, Wirecard claimed the earnings were stored in escrow accounts in Asian banks' funds, supposedly held as security. Those accounts became the foundation of the company's balance sheet, and they were complete fiction. Wirecard's fraud went far beyond just false revenue. The company engaged in round-tripping, moving its own money through layers of shell companies and reintroducing it as new income. It also acquired obscure payment firms at wildly inflated prices, allowing cash to disappear from its books while creating the illusion of valuable assets. In one deal in India, a company was purchased for 340 million euros, only weeks after it had been bought by another party for just 37 million. The transactions were labyrinthine. Analysts struggled to trace real cash flows. Critics began raising concerns, but Wirecard dismissed them as malicious attacks by short sellers trying to profit from a stock decline. The public, for the most part, believed Wirecard was a national champion being unfairly targeted. But someone refused to stop digging. In 2014, reporters at the Financial Times launched an investigation that would span 6 years. Led by journalist Dan McCrum, the team uncovered glaring inconsistencies in Wirecard's Asian operations. Evidence emerged suggesting forged contracts, inflated profits, and highly suspicious financial transfers. Wirecard retaliated aggressively. They hired private investigators to monitor journalists. Hackers tried to steal their communications. Legal teams accused the reporters of market manipulation. The Financial Times responded by escalating its security. McCrum worked inside a secure room, using computers disconnected from the internet. Whistleblowers communicated through encrypted messaging apps and disposable phones. Then, in 2018, a turning point arrived. A Wirecard employee in Singapore exposed internal documents that showed systematic falsification of financial records. A senior lawyer inside the company, Pav Gill, tried to report the misconduct to executives but was ignored. The fraud was no longer just speculation, it was documented. Germany's financial watchdog, BaFin, faced a mountain of evidence against Wirecard, but instead of investigating the company, the regulators pursued its critics. In 2019, BaFin took the rare and controversial step of banning the short selling of Wirecard stock, a move meant to protect the company from investors betting against it. Oversight agencies lacked resources. One audit reportedly relied on a single auditor examining a multi-billion-euro global enterprise. It later emerged that some regulatory staff had even been trading Wirecard shares themselves. Political influence also shielded the company. Germany's leadership promoted Wirecard as a national technology champion. Even Chancellor Angela Merkel advocated for the company's expansion abroad. National pride had become a protective shield for corporate deception. For over a decade, the global auditing firm had approved Wirecard's financial statements. But in 2020, everything changed. Auditors finally demanded direct confirmation of the cash balances supposedly held in Philippine escrow accounts. The banks involved BDO, Unibank, and the Bank of the Philippine Islands issued a stunning response. The accounts did not exist. The confirmation documents were forgeries. Within days, Wirecard admitted that 1.9 billion euros were missing. The company filed for insolvency shortly afterward. The collapse erased billions in shareholder value and sent shockwaves through global financial markets. At the center of it all was Marcus Brown, Wirecard's charismatic CEO. He had built a reputation as a visionary innovator, styling himself after tech icons and speaking about creating a universal financial network for the internet age. But behind him operated a very different figure. Chief Operating Officer Jan Marsalek controlled Wirecard's shadowy Asian operations and the TPA network. After the collapse, investigators uncovered astonishing connections between Marsalek and Russian intelligence agencies. He allegedly facilitated money laundering for covert operations and maintained relationships with intelligence officers across Europe. On the day he was dismissed from Wirecard, Marsalek vanished. He fled through multiple countries and ultimately resurfaced in Russia under a false identity. Reports suggest he continues to operate within intelligence networks, evading international arrest warrants to this day. Wirecard also launched cyber campaigns against its critics. The company hired private investigators and hacking groups to steal email credentials and monitor journalists and analysts. An Israeli contractor, Avira Mazari, coordinated hacking operations using international cybercriminal groups. The stolen information was then used to discredit investigators and manipulate public perception. Azari was later convicted in the United States and sentenced to prison for his role. Wirecard's collapse triggered legal actions across the globe. Executives and financial partners have received prison sentences in multiple countries. German lawmakers introduced sweeping financial reforms designed to prevent a similar fraud from ever happening again. Marcus Brown remains at the center of ongoing trials, where courts have already ordered him and other executives to pay massive damages for failing to protect investors. Yet the complete truth remains buried beneath millions of financial transactions still under investigation. Wirecard's ghost billions never existed as physical money, but their disappearance reshaped global financial oversight, auditing standards, and corporate accountability. The scandal revealed how technology, national pride, regulatory weakness, and human ambition can combine to produce catastrophic deception. Wirecard promised to build the financial infrastructure of the future. Instead, it built one of the most elaborate illusions in corporate history. And somewhere, beyond the reach of courtrooms and investigations, one of its chief architects remains a fugitive, a reminder that some crimes end not with closure, but with unanswered questions that linger in the shadows of global power. Thanks for watching.